Hey, welcome back to Everything Money. We're glad you joined us again. Today, we are talking about NVIDIA. We will head over to Mo, so handsome in his new red shirt. We will head over to Mo with trading. After we look at the financials, Paul will walk us through his 8-pillar process of looking at a company. We will use our software to see the financial data behind NVIDIA, the processing making company, the leading designer of graphics processing units. I'm reading this right off of our website, which we'll talk about moving forward. But Paul, your thoughts on, there's a lot of news about the graphics processors, a chip shortage with almost everything, the phones, Teslas, cars. It's kind of bonkers out there. What your thoughts on NVIDIA, Paul Gabriel?
All right. So first off, follow us on Instagram. Helps us out a lot, etc. So you'll see this from the data here. So first off, this is a $500 billion company. How long has NVIDIA been around for, by the way?
Let's find out.
A billion years?
Yeah, the max chart shows 2011.
Okay. So, $500 billion company for this. This is big. Look at their revenue, 22. That's 23 times sales. Even software businesses don't sell for that kind of multiple. And it's indicated right here. Their 5-year PE is 132. We want to see that less than 22.5. That's an X. Now, seeing the 1-year P at 74 versus the 5-year at 132, it tells me that there was a lot more profit in the last year than in previous years, okay? Their return on invested capital, very high, 14.8%. If we want it over 9%, so that's a check.
Yeah.
So far, 1X, 1 check. Look at this. Look at this dividend yield. Is this accurate? 0.1%?
Adorable.
That's adorable. But look at this free cash flow. The last 5-year average is $4 billion. Last year, they did 6.7. So again, last year, a lot of demand because people were staying home. They had to use graphics cards, etc. There's going to be a lot of demand for their products. It's going to jump up. So far, 1 check and 1X.
The dividend is accurate, and they were founded in 1993.
Gotcha.
Thanks.
Pillar number 3, revenue growth.
Yep.
We're looking for 8.34 to 22 billion. That's a check mark. But again, look at last year, 13 billion to 22 billion. Guys, to me, the apprehension is, look at their revenue growth over the years. And then all of a sudden, one incident occurs, COVID, and that's why it jumps up. You have to discount that. You have to realize that's not going to be a sustainable model, right? A lot of people spend a lot of money. It's just like Zoom. A lot of people spend a lot of money in Zoom, et cetera.
And with the way the chips are going, if you get a big massive drop, you would have to look at that differently also.
Correct. Exactly the same thing.
Yeah.
What pillar are we on, Paul?
Number 4 is net income growth.
Pillar number 4. Sorry.
2.3 billion to 7 billion. Oh. And again, they did 3.4 billion to 7 billion in the 1 year. They doubled in 1 year. So again, be apprehensive. Pillar number 5, shares outstanding.
Yes. What's going on?
They're diluting. 2.39 to 2.49.
Not the worst in the world, but
it's not the worst. You're right. It's not awful, but it's still increasing their shares outstanding. Over the last 10 years, they're pretty similar, 2.48 to 2.49. So now, the next one, guys, is we want to look at the 5-year free cash flow and compare it to debt. What I do is I take the 5-year free cash flow of $4 billion, I multiply it by 5. I come up with a number of $20 billion. I want their total long-term liabilities to be under that $20 billion. Why? Very simple. Are you more likely to stay in business or more likely to go bankrupt if you have less debt or more debt?
Does this help our sort of crash-proof thought process with a company?
That's actually a great point. Yeah, in any sort of recession, it's not crash because the stock market shouldn't be the business. They're going to sell chips where their stock is $1 billion a share or $1 a share. But what it is about recessions. If we hit a recession, and it is hard, by the way, for companies with these kind of margins to go under unless they have excessive debt. So we look at that $20 billion number. We go to the balance sheet. We scroll to the bottom. $13 billion in long-term liabilities. So what this means is they could pay off, if they just replicate their free cash flow, the last 5 years of free cash flow, the next 5 years, they could pay off all their debt in about 3 years' time. So imagine you at home that you had all your long-term liabilities, your car payment, your car loan, your house loan, anything long-term, and you could pay that all off in 3 years from your income.
Pretty good.
That'd be really good, right?
Yeah.
So those are the things to consider there.
Pillar number 7 is the grandmama of them all. Free cash flow growth over the past 5. I'm sure it's up, right, Paul?
1.94 to 6.67. And folks, we'll explain this to you. We add this line to make the math very easy for you because no cash flow statement actually has this line. But cash flow is cash from operations less your capital expenditures. We do this for you. And listen, I also love the capital expenditures aren't some huge chunk. It's less than 20% of their actual cash from operations. So it's not a capital intensive business. Then what we do is to come up with a value, $4 billion, we multiply by 20 as a starting point, $80 billion value. We want to see the value of the company under that number. So this is a definite X. This stock needs to fall a lot. The market cap is 500 billion. We want it less. We want it worth less than 80 billion as a starting point. To me, this just says overpriced. Move on, because the growth I don't think is going to be similar over the next 5 or 10 years that it was last year. And people are probably excited by seeing the big jump in revenue, big jump in free cash flow. People will storm right into it. But just like if Carnival Cruise Line, since Carnival Cruise Line didn't have any income, you would sit there and say it's worth zero. It's not worth zero. There's going to be a point when they come back to business. Same thing here. Their free cash flow is not going to be sustainable long term.
If you're looking to trade this stock at a quicker basis, Mo, I had a drink with one of my buddies last night who joined the bid and ask.
Oh, did he?
And he paid for 2 years of the bid and ask in his first month of trading. Is that typical? No, you may lose money, but he almost bursts into laughter at that idea of actually losing money when he follows the rules.
It's
you know
funny
what I mean?
when you follow the rules. Even when you do lose, you're going to mitigate risk. I mean, that's just how it works. The whole point of this, you are going to lose 2 or 3 out of 5 times. The point is when you make those losses, they're not detrimental to you. And if they're detrimental to you, you're doing something wrong and you're not following the rules.
This looks like in the overbought region.
Yeah, it's in the overbought, but I mean, a lot of people in the bid and ask started back here in April with this trade, ran it up through the sweet spot. You had a little bit of a blip here in the beginning of the summer. But since then, I mean, you really, Seth, you haven't dropped below 80%, meaning that you could have stayed in this thing, taken profits here and there, added back here and there. But at this point, this is our all-time high right here. So it's getting a little dicey. If I was in this position right now and I owned it, I would take some profits off the table just because you're getting that rollover right there. Doesn't mean exit the position. It just means take some profits off the table. Let's go over to a swing trading chart. I mean, this is looking really good. This is something that I might keep my eye on, actually. You're coming through the sweet spot very nicely. As soon as I get that yellow line in the sweet spot as well, I'll be on it. Make sure you get good volume. You're going to probably be able to push up through the 50 and 25-day moving average. And it's as simple as that. You'll be like Seth's friend.
If you want to access this data, you can go to YCharts and pay hundreds of dollars a month, or you can get it through us, the Everything Money software. The software that's behind Paul, the tools that we use on the show, is available through everythingmoney.com. Paul, tell them what to get, baby.
You get everything here on a mobile app. You get the 8 pillars. You get 30 years of financial data. You get the stock analyzer tool. You get news. You get the community of people to talk to. This is unbelievable. It's only 90 cents per day. So if you are serious about money and investing, which we all should be, this will pay for itself hundreds of times over, 90 cents per day. Our competitors are $200 a month, $200 a month, and $35 a month. They don't give you anything compared to what we do. And we give you exclusive content every day, other stock analysis that you don't get on YouTube. So again, go to everythingmoney.com or Patreon and sign up below. So now this is the hard one.
Mm-hmm.
A big chunk of these revenue growth numbers are skewed because of last year. So I want to go a lot lower. Do I think that the world of graphics cards is growing as the world becomes more developed? Yes, I do.
Mm-hmm.
So I'm putting 8, 12, and 16% revenue growth. Share change, even though they had a 3.7%, I'm going to go 1, 0.5, and 0. Profit margin, free cash flow margin, and my assumptions on PE and free cash flow. Now look at this, Seth. These are the PE and free cash flow, and I dropped them down because, guys, this is a big company. They shouldn't be selling for 75 times earnings and free cash flow. They're established. They've been around for 30 years. This is not a startup anymore, okay? And these growth rates don't justify 80 times free cash flow. So I decreased it. I put 15, 12.5, 10% on my annual return. The stock is currently 210, and no surprise at all, I want to be in the mid-40s. You might sit there and say, that's not going to happen. Okay.
That was 2 years ago.
Yeah, and I look at it going, guys, but every investment's a present value future cash flow. You might sit there and say, well, the stocks over long periods of time will chase earnings and free cash flow. That's it. Now, obviously, other factors do affect it, like share change, et cetera, but all things equal, the more revenue, the more profit, the more free cash flow is generated, the more valuable the business is. Because if I came to you and said, hey, you can buy this business for $100, it's going to give you $10 a year in free cash flow. Or you can buy this business for $100, it's going to give you $1 a year free cash flow. Now, is that enough to make a decision? No, but that $1 better grow a ton for you to really justify it. This growth this is already an established business with billions of dollars in revenue. This is going to be very hard for them to grow 20, 30% a year for long extended periods of time.
In the end, folks, this is how we invest and how we think. We're trying to teach a process. My process for a decade was just looking at NVIDIA stock at 200, watching other YouTubers or listening to news and saying it's going to go up, then buying and hoping. If this resonates with you, our process, feel free to join our community. You can get access to software, and you can start thinking this way. It'll take some time. It's a new language and take some discipline, but I love hearing your process about this, Paul, and it really helps me moving forward with life to have a real grasp about how I should be investing my money. So
you're welcome.
That's our video. Thanks for watching. Final thumbs up. I love you guys. See ya.